Hello, thanks for clicking on my video. Today, what I want to do is I want to continue in my series of focusing on the protection component of our financial plan, our developing a financial plan. And specifically, I want to talk about life insurance. Now please don't X out. Really, nobody wants to talk about life insurance, but really, it's life insurance is a very important aspect of a comprehensive and successful financial plan. In addition to that, I get a lot of questions when I'm working with people about life insurance because there's a lot of misunderstandings and misconceptions about it. And so what I want to do today is I'm hoping to share information with you. So by the end of the video, you have a much better understanding of how life insurance works. So there's probably about hundreds or even maybe thousands of different life insurance products out there. But when you boil it down, there's just two kinds. There's term insurance and there's permanent insurance. Now, term insurance is just that. You are buying or paying for protection for a specified period of time. And if you die within that specified period of time, your beneficiaries get a death benefit. Now, term insurance is very inexpensive. And there's a reason why, and that is people that buy term policies, there's a 95% probability that they're going to outlive that term policy. So think about that. If the insurance company is only paying out 5% of the time, that's why they can price it so low. Whereas with permanent life insurance, that contract stays in force until the day we actually die. So there's a 100% probability that that life insurance company is going to have to pay a claim. So they price it much higher. But there's also some inherent benefits to permanent life insurance too that I'm going to cover here. Now, before I go into my illustration, I do want to say that I'm not advocating for one or the other. One isn't better than the other. They both do a great job for what they're designed to do. And your advisor, whoever you're working with, will give you guidance as to which one might work best for your situation. Sometimes it's all term, sometimes it's all permanent, or sometimes it's a combination of the two. So that's where your advisor will give you the guidance on which way to go and which is best for you. So let me go ahead and get into my presentation and share my screen with you. So let's go ahead and talk about a life insurance policy or somebody who's interested in buying a $500,000 life insurance policy. Now, when it comes to that policy, there is a minimum amount that you can pay, and there's a maximum amount that you can pay for that life insurance policy. Now, who do you think sets the minimum cost for that life insurance policy? Well, it's the insurance company. They have actuaries there that can determine what is the least amount that they can charge and still make a profit. Now, who do you think sets the maximum amount that somebody can pay for that life insurance policy? You may be surprised. It's the government. Now, why would the government be so interested in how much somebody can pay into this contract? And by the way, there are almost like an infinite number of product designs in developing a contract, a life contract. And if you went to 6 or 7 different life insurance companies, you'd get 6 or 7 different ways that you could pay for this thing. But why is it that you think the government was so interested in how much people can pay into these contracts? Well, if you guessed taxes, you'd be right. So back in the 80s, the government realized that people were putting a lot of money into these contracts and they were missing out on revenue, or I should say taxes. And so they were really making a push for people to put their money into another type of vehicle, and that is qualified plans. So qualified plans are things like IRAs, 401ks, SEPs, and like 403bs. Now, this video is, I'm not going to talk about qualified plans. I do have another video where I go deep into what qualified plans and how they work. And I also want to say that I am not speaking out against qualified plans or dogging them. I'm just giving you some information because, like I said, all products, no products are good, no products are bad. It's how they're used and when they might be most appropriate for you. So when we talk about qualified plans, keep a couple of things in mind. Qualified plans do two things. They defer the tax. So the IRS knows that you're not going to pay tax. You're just going to pay it later. So rather than defer, I like to use the word postpone. So you're really just postponing the tax to a later time in your life. But you're also going to be postponing the tax calculation, right? A couple of questions to ask yourself is, what tax bracket are you going to be in when you retire? Taxes have gone up, they've gone down, and we don't know what taxes are going to be when we retire. If they're lower when we retire, then boy, that worked out really well for you. But what if taxes are higher? Then that's not a good deal for you, because you're going to end up paying more income tax later than you would have if you had just paid income tax at the time. The other thing to consider is, what deductions are you going to have when you take the money? Now, most of the retirees that I work with, they have paid off their mortgage, so they're missing out on the mortgage interest deduction, and they don't have any kids living with them anymore, any dependents living with them anymore. So at the time that we could really benefit from tax deductions because we're having to live off our savings, we don't have any. So just kind of keep those things in mind, all right, when you're thinking about qualified plans. Now, back to life insurance, all right? So like I was saying, the government set a maximum amount that somebody could pay into this life contract. And if you pay over that amount, then your life insurance contract turns into what's called a modified endowment contract. And so therefore, any monies that you have in this life insurance contract are going to be treated just like a qualified plan, with all the same rules and restrictions and regulations that go along with that. Now, let's say for this $500,000 life insurance plan, the minimum that somebody could pay for it is $500, right? And that's a good deal, because we're always taught that we want to get maximum benefit for the least amount of money. Well, you could also pay, according to the government for this contract, in this particular situation, a maximum of $10,000 for that same $500,000 death benefit. So that's quite interesting, right? That's quite a bit of difference in money, paying $500 versus up to $10,000. Now, if you go with the cheapest way to pay, where you're getting the maximum benefit for the least amount of money, then you're talking about term insurance, all right? Because what you're going to get with term insurance is you're going to get the biggest benefit for the least amount of money. But what you're going to get for that money is purely death benefit. That is it. And like I said before, if you die within the term of that contract, well, then your beneficiaries get that $500,000. But what if we have somebody who's considering paying $10,000 into this life contract? And now let's set aside the life insurance contract concept for a minute. And let's just talk about somebody wanting to pay $10,000 into some kind of account. And if they were going to pay that amount of money, they would expect some kind of benefits from that. And when I ask people that I'm working with, what are some of the things that you want that money, or what kind of benefits would you want to have in return for that money? Well, tax deferred growth always comes up, because that's what they've been taught, and that's what they've learned about when it comes to qualified plans. So tax deferred growth is always on the top of the list. The other thing is that they could get tax-free distributions from that account. Boy, that would be wonderful, because then they don't have to worry about what tax bracket they're in when they retire. If they could earn a competitive return, that's all the more better. If they could make contributions in the amounts that they want, and they don't have to worry about the government limitations on what they can contribute, that's also a big benefit. But what about some additional benefits? Like, for instance, if it was protected from lawsuits, or if it had long-term care benefits built in, that would be great. And what about if I wanted to use this account as collateral if I wanted to borrow money from a bank? That would be very helpful. And is it safe? I want this money to be safe. And gosh, if there was a no loss provision built into it, in other words, if the markets crashed and and my account wasn't impacted by that, that would be fantastic. And what about guaranteed loan option? If I wanted to borrow against this, I'd like to be able to do that without having to fill out a loan application or have to qualify. And what about if I decided, if I did borrow the money, I decided how and when I wanted to pay back the loan, if even at all. And what about liquidity? Say something comes up that I didn't plan for. Do I have access to that capital in that account without any kind of penalty or fee attached to it? And lastly, if I could deduct the contributions that I made into that product, that would be wonderful. So when I'm talking with people and we're thinking about where's the best place to put that $10,000 and what kind of product, well, this is kind of like the standard right here of benefits that people kind of consider. These are the ones that come up the most. So as they're looking for some place to put their money, the more of those benefits that are included in that product, well, the better fit it is for them. So when it comes to term insurance, remember, you're getting the biggest amount of value for the least amount of money. Well, with term insurance, you get one thing, and that is a death benefit. All right. But think about this. If an insurance company is telling you to pay $10,000 for a $500,000 death benefit when somebody can get it as cheap as $500 a year, they better have some really good reasons for you to pay that additional money. I mean, at least anybody would expect that, right? Well, when it comes to a permanent life plan, you actually not only get the death benefit, but you get living benefits as well. And as you pay into that contract over time, those living benefits start coming to fruition. And so when you're paying the maximum amount of money into that life insurance contract without going over that line and preventing it from becoming a modified endowment contract, then you have designed a contract with what we call a maximum efficient contract, and that's permanent life insurance. And so this kind of explains the benefits. If you want pure protection for the cheapest amount that you can get, then that's where term comes in. But if you want a place where you can put in extra money and have living benefits, then that's where a permanent life plan may really work for you. Now, like I said before, I'm not saying one is right and one is wrong. It's whatever is best for you. And as I mentioned, that's where your advisor can come in. So I hope this video helped you understand more about life insurance and how it works. If you have any questions, reach out to me. Also, please don't forget to subscribe to my channel and like this video, and then hit the notifications so that way you can know when I add more videos, because I'm going to continue in my series of developing a comprehensive financial plan. Thanks for joining me today. Take care.